everybody, and welcome. We're going to give a couple more minutes for the folks to trickle in, and then we'll get started.
Hi, everyone.
Hi, Char. Hello, everyone. Thanks for those who have joined us so far. We're going to just give one more minute for folks to trickle into our Zoom room, and then we'll get started. Hello, everybody. I think we'll get started here. So thank you so much for joining us today. I'm Michelle Boyd. I help run Turner Labs, the nonprofit arm of the Turner Center for Housing Innovation. The Turner Center for Housing Innovation is a policy and research institution at the University of California, Berkeley that focuses on advancing housing affordability and equity through questions around supply, access, homelessness, and affordability. The Turner Labs directly works with innovative technology and nonprofit and for-profit business ventures that we think can help solve these broad goals around affordability and equity. So really excited to be partnering with the Economic Architecture Project, which I'll pass it over to Stuart to explain on this series, highlighting work of change makers on important housing issues. I'm mostly going to take a back seat today as my colleague Stuart is going to lead the conversation. I just want to thank you so much for being here. This session will be recorded and available online after we're done. And with that, I want to thank all our panelists for being here, and I'll pass it over to Stuart.
Thank you, Michelle. My name is Stuart Yasker. I'm a leadership group member at Ashoka, and I lead the Economic Architecture Project. And I'd like to welcome you all to the conversation today. We come to this work through a 2-year partnership that we've had with the Brookings Institution to address the devaluation of homes in Black majority neighborhoods. This work is anchored in a report authored by our co-conspirator, Dr. Andre Perry, and his co-authors, Dr. Jonathan Rothwell and David Harshbarger. It shows that homes in Black majority neighborhoods are devalued by over $156 billion. Over the last year and a half, we've looked at over 6,000 organizations working in housing in this country to get a better understanding of the causes of devaluation, the innovative solutions that are being developed to address it, and the biggest opportunities for change. While there's more to devaluation of homes in Black majority neighborhoods than just appraisals, appraisals do play an important role. And this is something the public is becoming increasingly aware of as the press has begun to document specific cases. For example, people are learning about the story of Carlette Duffy, who received appraisals of $125,000 and $110,000. But then when she stripped her home of all signs of her racial and cultural identity and had the white husband of a friend stand in for her during the appraiser's visit, the home was appraised for $259,000, more than twice the original amount. Or the story of Paul and Tanisha Tate Austin, a Black couple who received an appraisal for $995,000 in Marin City. After they staged the home and removed any indication of their race or ethnicity and asked a white friend to greet the appraiser, the appraisal came in at $1.48 million, which is a difference of approximately $500,000. With the growing attention on this topic, the GSEs have begun to release some system-wide data on appraisals. For example, in 2021, a study by Freddie Mac showed that appraisals for home purchases in majority Black and majority Latino neighborhoods were about twice as likely to result in a value below the contract price than appraisals in white majority neighborhoods. While many researchers say we still need access to more data, there's a growing consensus that there's a problem that needs to be addressed. And in a rare moment of opportunity, we see policymakers at the city, state, and federal levels, financial institutions, appraisers, appraisal management companies, and appraisal industry groups begin to explore solutions. The PAVE Action Plan announced by Vice President Harris was an important step forward. It strengthens guardrails, enforcement and accountability, and fair housing and lending practices. It calls for diversifying the appraiser workforce, empowering consumers, and providing researchers with access to data. It also set an agenda for future research into scaling up alternatives to traditional appraisals, adopting value estimate ranges rather than pinpointing exact prices, exploring alternatives to the sales comparison approach, and to fostering development of new unbiased valuation methods. This unique moment of opportunity also poses a challenge. It asks us to think creatively, to look beyond solutions we're already aware of, and to keep an eye on creating the kind of structural changes that are required to address appraisal bias. Today, we're joined by three innovators who are contributing to that conversation with three very different kinds of new ideas for changing the appraisals and the appraisal process. And it's my pleasure to introduce and welcome Rosalind Williams from With Action, Charu Singh from Humane Works, and John List from True Footage. To get the ball rolling, I'd love to start by asking each of you to share a little about why you're doing this work and what you hope will be different when you succeed. Rosalind, can I pass the baton to you to get the ball rolling here?
Yes, it's nice to be a part of this panel. We're doing this project and have this idea because in weak markets like St. Louis, where we are, we have a very severe case of segregation, and that segregation is used as a marker for appraisals. No properties that are north of a certain line appraised out as a white neighborhood south of that line. So you can't get much improvement in a Black neighborhood unless we attack the appraisal issue.
Great. Charu, can you share a little bit about your motivations for this?
Hi, happy to. Well, my commitment to solving racial inequity problems has been a lifelong cause for me. And with the shift that's happened in the real estate industry and society at large over the past 5-6 years, I noticed that the conversation has really shifted, and the willingness to look for innovative ideas at the intersection of the tools of real estate and technology working in communities has really opened up in a way that never existed before. And what I hope to achieve is really a new approach to assessing home values, particularly in communities of color, so that home values are more equitable, and to find ways to help homeowners access that additional equity in their homes. And thereby really changing the value of their homes to one that is undervalued and biased, to one that is equitable and a platform for equitable wealth generation for those households.
Great. And John, can you share a little bit?
Yeah. So the company is called True Footage. We launched in July of 2021. We are a national appraisal company that's live currently in 26 states. And our goal is to leverage technology as well as train new participants into the industry. And I started this company because as a real estate agent and someone who has a background in real estate investing, I saw that data quality was a major problem throughout the mortgage process, in particular, getting access to interior data that was accurate. And by allowing for that data to be more accurate, there will be a more objective process in the appraisal process. And so we started the company and are continuing to grow throughout the United States.
That's great. And Rosalind, I wonder if I can come back to you for a second, which is, you referenced the Delmar Divide. And I, if
yes.
folks know St. Louis, they'll know it clearly. If they don't, I don't know if everybody across the country appreciates just how stark the divide is. And in some ways, your work, it's informed by the Delmar Divide, goes right to the heart of some of this. Can you help paint the picture a little bit so people can get a sense for what it looks like if they were there, and how your solution addresses that?
Okay. Well, the Delmar Divide is literally down the middle of St. Louis, going east and west. North of the Delmar Divide, mostly African-American communities that used to be white communities, but over time, the white communities white residents have moved out to the county, and the county has its own divide, which is the Olive Divide. And so most of the activity, and right now the real estate market is very, very hot south of the Delmar Divide, and almost non-existent north of the Delmar Divide. You have neighborhoods that are right across the street from each other on Delmar, and we put in our application the difference of $100,000 in value between one neighborhood and another. And if you looked at the pictures of the housing stock, and St. Louis has beautiful housing stock, but if you look at the pictures, you can't tell the difference between that neighborhood north versus the one south. And so what we're trying to do is say the locational analysis that's been done, is required by Fannie Mae, should just be ignored because of the historic impact of racist appraisals has changed the environment of Black communities, from employment opportunities to all kinds of transportation issues, and it's just the opposite south. So we are just trying to get rid of race as a calculus in appraisals. And so if you can go 2.5 miles out for an appraisal in a white community, according to the Freddie Mac, right, report, then you can go to a white neighborhood and use those comparables for a neighborhood on the north side. And that's primarily our proposal, is to discount the locational analysis, because that is the basis of the racism that has been perpetuated.
Yeah, and in some ways, it's very powerful, looking at the comp-based approach, which so many have pointed to as a mechanism for carrying kind of the impacts of racist policies into the future. And instead, your proposal by saying you have to consider the prices of homes in, for example, nearby white majority neighborhoods, would use that same comp-based approach to have a restorative impact on home prices potentially. Right.
And well, if you just look at neighborhoods that are right across the street from each other, it makes no sense other than consideration of race. But after 100 years of devaluing these neighborhoods, they just can't ever appreciate, have the amenities that add value to a home. And so it is very stark. I mean, I think the Delmar Divide came from a report by an English reporter who just took pictures of one side and then the other side, and it's like night and day kind of thing.
And Char, your work goes to, as Rosalind's work is focusing on changing the use of comp-based models, your work really focuses also on AVMs, automated valuation models, around which some people are very enthusiastic because there's hopes that technology can help remove the role of subjective judgment and the bias that might enter, and others are wary because we know that technology bias can be written into algorithms and technology as well. Can you share a little bit about how your work tries to consciously address the existing bias through AVMs?
Sure, I'm happy to. And actually, there's a lot of overlap between Rosalind's work and my own. The first being that we share the same premise, that there is bias in the valuation of homes in communities of color. This is the first time I'm actually getting to hear about your work, Rosalind, so I'd like to hear more in the future. But I actually sort of take the opposite approach, which is to acknowledge there are differences in communities and the amenities that are there, and that's a problem that needs to be addressed. But what the AVM addresses is an inequitable approach to valuing the intrinsic characteristics of a home, or the physical characteristics such as the bedrooms and bathrooms, the value of that home as shelter. And there have been early studies conducted by Brookings, for instance, and also Redfin, that identify that there's about a $46,000 difference in homes based purely on a difference in how the same home might be valued. And so what the AVM is able to do in a way that humans have a very hard time doing is absorbing a lot of data and also parsing that data so that we can allocate value to the community amenities that a home benefits from or does not benefit from, and also the characteristics of that home. In terms of how do you address bias within data, I think that's something that we're all sort of trying to figure out, and we're in the 1.0 version of that at the moment. I think the way that Just Value tries to avoid the pitfalls of data is by not telling you what the market value is, but identifying what the equitable value is. And that's to address race head on. It's not to think about what is the transactionable value, but what should the value be today if that home's intrinsic characteristics were valued equitably. And I don't think Just Value is perfect, but I also think it's a fallacy to think that any AVM would be perfect. There is no single value to any good that we have, that really it is within a range that is derived from the market, derived from the characteristics of the asset, but also our broader financial system. And so I think an AVM like Just Value is really just part of a toolbox of solutions that we need that include the finance industry, municipalities, municipal financing, working with the appraisal industry. I think it really is a suite of solutions that have to be brought to bear together.
And John, your approach is, in some ways very different in that you are now actually, you've launched the company, you're outgrowing, you're doing appraisals right now. Can you share, the appraisal industry we know as an industry has run into difficulties in terms of growing, in terms of attracting new talent. Can you share a little bit about why you see such a rosy picture here for appraisals and what the opportunity is and why you were moved to step into the space?
Yeah, absolutely. I think that, first of all, it's a two-part question: is why is the appraisal industry attractive? And then, what has happened? Why are we where we are with the appraisal industry, where, by all metrics, it's an older population of people. It's dominated by white males. And so it doesn't represent America from a representation perspective. So the answer to that is because of the training process and the apprenticeship programs that were required to become an appraiser. It became very densely populated by networks of people who either got into the industry because of a relative or a family friend or someone in their community. And so there was very little incentive for people to train others into the industry because it was, felt like they were training their competition. So that's why we resulted in that. And then a lot of the government regulations after the financial crisis in 2009 perpetuated those issues and exacerbated the issues and made things worse. So that's kind of where we're at. And there are several community groups looking to change the representation in the industry. And And that's really, really important, but that's not enough. That's not going to solve all of the problems. And so what we think needs to happen is kind of reimagining the entire space and leveraging technology, but still keeping a human in the loop. We think technology unfettered has severe limitations. I mean, you saw Zillow, fall dramatically when they relied too much on technology. And there's just some things about the home that cannot be shown through data alone. And so we really believe that there's this intersectionality that is required. And so we are kind of attacking the problem from both building up the labor force, but also leveraging technology and building something kind of in the middle.
Great. And yes, Steve, thank you for your comment. And we can try to get closer to the mics and make sure that the audio is a little better. John, we want to make sure people can hear what you're.
I've never been told that I'm too quiet, so that's a first.
It's new territory. But I'd invite others. You're welcome to contribute questions to the chat if you want. We will try to kind of incorporate them in if helpful. You mentioned something, and maybe I can start with a provocative statement, because this conversation is relatively new in its current form, and I think people have they're appreciating the magnitude of it. This is appraisals are critical to the pricing mechanism of a $43 trillion market, which is one of the largest assets anywhere in the world. So it is critical. It has an enormous impact on people's lives and potentially contributing to the racial wealth gap. But as a new conversation, I think we've seen people focus a lot on specific anecdotal examples. And there are also some sense that people who've come to the conversation may get the misperception that there's kind of a blaming of the appraisers. And so I just want to float this out as, I don't think in any of your work that you're saying that the appraisers are the problem. Instead, I think that there's, in each of your work, there's a way in which appraisers really are a critical part of the solution. But I think it's important for us to address that head on, because I think this is a large community of people who also can be invited into helping to address this. Do any of you want to respond to that?
I'm happy to. Having used appraisers quite a lot in my career, I really think that they have been made a scapegoat for what really is a systemic problem that really stems from the founding of our country and the development of our real estate industry, that by design, the appraisal industry has been was designed to be exclusionary. And the problem is that the appraisal industry really never grew up beyond that. And so let me just list some of the ways that appraisers are hamstrung. So we do see homeowners, and I think anybody can see sort of the subjectivity of an appraisal, that there is subjectivity there. But what I think a lot of people outside of the industry don't see are all the ways that an appraiser is constrained. So there's the sort of socio-political piece of it, where they're working with brokers who are also price setting. They're working with lenders who may be trying to hit a certain sales price. And appeasing those two groups is an important part of appraisers keeping their network and remaining relevant and used within that network of brokers and lenders who give them business. The other thing is that appraisers themselves are typically freelancers. And so again, this gives them very little agency and requires that they rely on their network very heavily and these relationships really heavily. Thirdly, they have guidelines. Appraisers have guidelines that limit how much they can adjust a comp. And that on its face prevents appraisers from going outside of a certain geographic area to be able to capture value. And these days, fourthly, they're also monitored by an AVM. So they can submit a human-led appraisal and say they went across the Delmar Divide in Rosalind's case and made a big adjustment based on community, but not based on the intrinsic characteristics of the home. That AVM would send back that appraisal as something that does not comply with guidelines and would not be bought by one of the GSEs. And so there is always personal bias in all of our work. I think that's something we cannot remove from our society as humans. But there are also really structural constraints that limit how appraisers come to determine value that are really methodological and systemic.
Yes, please, Rosalind.
Just wanted to add to that. The appraiser on our team is, says first appraisers have to do things quickly. They're kind of given guidelines and they just kind of churn them out in many cases. So it's the problem with the guidelines. If you read Fannie Mae's vocational guidelines, there are a lot of problems that I don't know if a technological system would be able to unravel them. Let's put it that way. The other thing is that we've been working or talking to banks who want to provide mortgages and things in St. Louis, north of Delmar, and they are considering holding all their loans in portfolio so that they don't have to deal with Fannie Mae, which is, one way that we think that we're going to be able to prove have a test case or test neighborhood to develop. Because as is pointed out, there are multiple issues going on in the Black community. Appraisal is just kind of it's the cap that keeps things from improving, but confusing discrimination in housing with systemic racism in the appraisal system is one of the problems, I think. It's not as you said, it's not necessarily the appraiser, it's just that they have to follow, or else they're afraid they're going to get into trouble. And so what we're doing is saying there is a comparable neighborhood by housing style or the value of a house in a white neighborhood that obviously is not a part of the consideration of race and the results of racism over time. And so that's how we're looking at it. And we hope to be able to get appraisers that will do a restorative appraisal rather than a Fannie Mae kind of appraisal.
Yeah, just to chime in last here, I completely echo what was being said initially. There's a huge issue in the appraisal industry that's not often discussed, and it was actually brought up by one of the congressmen in the hearing most recently a few months ago around confirmation bias. And what confirmation bias is that in the purchase process in particular, appraisers are under immense pressure to hit contract prices. Otherwise, they get blacklisted by the bank or their customer. And as mentioned, a lot of these people are 1099s and rely on those relationships in order to make their living. And if appraisers don't hit those contract prices, they are out of a job. And that is where you see a lot of the appraisal gap that's been identified by Freddie Mac in the purchase process around a gap in what percent of the contract prices are being hit in white majority neighborhoods versus Latino and African-American majority neighborhoods. It's around 83% in Hispanic neighborhoods, 87% in Black neighborhoods, and 92.8% in white neighborhoods. And that's because there's less availability of comps in the minority areas to hit the contract price. And so if we want to talk about fixing this problem, we need to really reevaluate this issue of confirmation bias that's been documented for now 12 years and we haven't really seen much movement on. But I think that would result in a huge difference and also create an environment that got buy-in from appraisers to participate in making that change, as appraisers do feel a little bit under fire right now by the media based on how they're being portrayed in their kind of occupation.
So how do we, as we're looking at it, if so there are obviously changes that need to come about in the appraisal, the labor market for appraisers, right? I think, we've all talked about this. We know the numbers, roughly 96%, 96.5% of appraisers are white and 70% are male, and it's declining by, I think, 2.5% per year. So there's obviously a need to change the labor market for appraisers. But if it's not all on the shoulder of appraisers to address these structural and systemic pieces, how do we keep a focus on those kind of structural elements that really can make a difference in dealing with the appraisal gap here?
I think there's two things. One is really taking a hard look at the methodology itself. And the PAVE report, John, I think those are the hearings you might have been referring to just now. They do mention that the methodology itself, it does perpetuate bias, and that the data that underlies our current methodology, the sales comp approach for single family homes, can perpetuate bias. So I think that really continuing to push on methodological change is important. And at the same time, I think the work that you're doing, John, is really interesting, because if you are changing the methodology, you really are changing the entire industry. That methodology is really easy to train on, but some sort of hybrid methodology that takes in more information requires a different type of training, and likely a different set of tools. And so that report really, I think, provides a roadmap of what the future of appraising can look like, of the industry can look like, which is wildly different from what it is today. And then the other piece that also is very interesting to me is it's not just about the value, it's about how do you access that value, building financial instruments that will help homeowners access this additional value in their home. And that to me is the really tricky piece of it, because of perceived risk, and because of really segregation of our communities. So going back to your previous question, Stuart, what are one of the constraints that appraisers may think about? Well, they are appraising for what is the likely price that a home may transact. And when our communities are segregated, as they often are in small and large cities, the incomes that you may have of homeowners buying homes in communities of color could be lower. Their access to financing could be lower. And so their purchasing power in those homes, in those communities, may be lower. And that might be something that brokers are including in their calculus of what a home is worth, and what financiers are thinking about when they are pushing for a certain type of price. And so without the ability to finance that additional value, I really think it's a fictional concept, or an academic concept that really needs tools to help homeowners bring liquidity to what would be a more equitable price.
I want to bring up a point. What we had thought of is that because of the stigma of Black communities, and also the assumption that the only people who want to live in Black communities are Black people, is a major problem. In order to make neighborhoods inclusive, you have to bring in higher income and other people who are supposedly in the market. And so we've considered putting in a home equity assurance program, would give us an incentive for people to buy into a Black community, because it guarantees their value. And especially if we're using the restorative appraisal, that gives cover for the banks as well. And everyone, including the appraiser, should consider that a guarantee, or a reducing the risk for everybody. The other thing is that you don't have people in the Black community investing in their homes when they're selling their house, because they don't think that they're going to, history shows that they're not going to get the value. And so if you can incentivize people to have confidence in the future, then people will invest in their homes, and that will increase the value of the individual homes as well as the neighborhood, we hope. I'd like to ask a question of John. How would you take into account in the home equity assurance type guarantee in a neighborhood?
I'm not that familiar with what you're talking about.
Yeah, well, it's a program that was used in Oak Park, Illinois at the time of a lot of demographic changes in Chicago area. And they were trying to stop white residents, homeowners, from leaving, from going further out in the Chicago area. And so they just said, if you stay for 5 years, and you get an appraisal now and stay for 5 years, and you want to sell your house 5 years from now, we will guarantee that you will not lose value. And if you did, we'd make it up. We'd make the difference up. And primarily what we're trying to do is kind of almost the opposite. It's trying to attract people in and guarantee that they will maintain the value when they invest in the neighborhood.
Got it. Yeah, I mean, I'm not that familiar with that program or the history there, so it's hard to say. I will say that I do think that some of this government enforced redlining and the way in which we think about neighborhoods and the Delmar Divide is not so different from that, does get structurally passed down to appraisers and the mortgage system. And there's ways to leverage data to reimagine the way that we think about neighborhoods and boundaries that can materially increase the objectivity of value and get rid of some of the kind of relics of redlining. And so that's something that we're exploring right now. I think that oftentimes appraisers from older generations and people from older generations just have different reputations and feelings about neighborhoods and what that's like and how it should be discounted than current, perceptions of neighborhoods. For example, my parents probably have a very different perception of Brooklyn than I do as a New Yorker. And so oftentimes those perceptions can get perpetuated down into the appraisal process if an appraiser is not kind of market competent in real time. And so that's something that we are working on, kind of training our appraisers to make sure and building data products in that space to ensure that that doesn't happen.
Right.
One piece that comes up a lot, and I wonder if you could comment on in each of your own ways, is the importance of data throughout this piece. I mean, in some ways, the housing market has a lot of data available. In another way, we know that there's much more system-wide data than folks often have access to. Not debating why that access isn't there and et cetera, but how helpful would it be, and what difference would it make if you had access to different kinds of data to your different approaches?
It would be huge. I think for everybody, obviously data is, massive. There's lots of problems with the integrity of the data just because there's a lot of different data collectors and a lot of different, there's over 750 MLSs in the United States, and a lot of that information is coded very differently depending on which region you're in. So it is quite difficult to get to ground truth. Plus you have brokers who are incentivized to gross up square footage, and then you have assessors and homeowners who are incentivized to gross down square footage to get their taxes lowered. So you have a lot of issues in terms of the kind of integrity of the data. But if we could get access to all of the data that Fannie and Freddie do have access to, it would allow for incredible advancements in the AVM technology, as well as kind of resulting in much more objective reporting in the appraisal process.
I concur with John, and I have sort of this ongoing pursuit to find sort of what is my holy grail of data, which is mortgage valuation data. So you can get access to lots and lots of mortgage data, but the mortgage valuation data is really very difficult to obtain and is mostly held by lenders, appraisers, and the GSEs, and all are regulated to keep it private. And if that type of data became available, it would be really the way to understand how the sales comparable approach does create bias. Without that data, really you're using proxies and supposition about where the bias exists. And so for me, that on the policy side, that's really one of the biggest areas of change I would like to see. More willingness to share that particular information and even to share real appraisals, because as somebody has pointed out here in the chat, that they're a new appraiser and have had 3 different supervisors and been taught 3 different ways of approaching appraisals, which I think is a very common story. And that means that we see all that differentiation within appraisal reports, within the comp set, and finally within the valuation. And so, I think there's a lot of concern about liability within the industry right now. And I wish that there was a way to get beyond that so that we can actually understand how bias is appearing in this system and come up with solutions. Lastly, I just think that this is a tremendous opportunity for academics and researchers and private sector and the nonprofit world to work together to find really creative solutions. I would say data is one of the number one ways, one of the number one roadblocks to creating new partnerships around these topics. And that's why I think you see such little innovation in this space of the housing world. So if anybody from Freddie Mac listening, lenders, call me.
Great. And before too much time goes, let me just ask if there's a question from Angela about the practical applications of real estate applications program. Or does anybody have any comments they want to share on? Is anybody familiar enough with the program to share some insights or thoughts there?
We're building something in-house right now. We have a proprietary curriculum and we're looking at gaining acceptance with PIREA. I think it certainly has promise. I think that obviously, like any other industry we've gone through the pandemic, we've seen that there's a lot of work that can be done remotely that can speed up the process to get people out as certified appraisers, as well as limit the amount of time that's required in the field, which is a huge bottleneck in terms of processing more appraisers into an industry that's seeing an anemic growth and has a shortage of labor supply. But I also caution that we cannot limit the rigor of the process of becoming an appraiser. It's extremely difficult. Appraisers are expected to, understand pretty complex math. And so I don't think the idea that anyone could get trained into the appraisal industry overnight is true. I think we need to maintain a rigorous program, but expand accessibility through things like PIREA.
Great. Yep. Please go ahead, Rosa.
I understand that there's an apprentice kind of approach to appraisals. So I guess you would have to first educate the appraisers who are, taking young appraisers in as apprentices, which is an interesting problem. Uneducate them, I guess you would say.
And digitizing of whether it's the home or the process of doing the appraisals or developing digital tools like AVMs is certainly kind of one of the macro trends we're seeing in the space. And part of the question is, if those things are moving forward, how do they move forward to address these kind of structural issues that are already built into the system? Curious about what you think are some of the really bright spots here. Areas of biggest opportunities?
Well, I think just conversations like this are a real, are just a tremendous change from anything that has occurred in the real estate industry in, I think, until now, really on the topic of racial equity, that we are in a moment of real change, I hope, lasting change within our industry, where we are much more open to looking at racial inequity within the industry and looking for creative solutions to that. I think I've been very inspired by the challenge itself and the myriad of solutions that have been brought to bear, and the varying scales of them. And so I really don't think a challenge like this would have even happened 5 years ago. So I think one of the biggest things for me as an advocate in my career for racial equity and social equity is the ability to have these conversations in a much more meaningful way with a much larger group of professionals, and with the participation of white people within the industry who are trying to learn and think about solutions and really interested in partnership in a way that I have not seen in my career.
I ditto that. Since we've, been selected as one of the innovators, we've been invited by the the realtor community to give presentations, and we're also going to the Appraisal Institute, at that conference, to also give presentations and talk about what we're trying to do. So, and I think, as you said, it hasn't come up in this way, and everybody's been very defensive. Otherwise, they don't want to think about that. Sorry.
I'm interested in answering this question, Stuart, that's in the chat.
I was just going to bring us
Okay.
to great. I think there are two, which I want to float them both, because we don't have that much time left here. But one, Angela's asking, there are issues of bias in the system, but also the need to address training in the appraisers of cultural competency and the elimination of bias. Can we speak to the topic? And this other question, which I think is also very poignant, and we should be curious of your reactions. Any comments on lenders such as Wells Fargo and how they've slowed the appraisal turnarounds on refinance of minority consumers, causing increased interest rates or outright denials? Black homeowners have lost millions during the historic low interest rate period because they couldn't refinance. Can you share your thoughts on these questions?
Well, I'll take the second, because I'm quite. This is something that really sort of Wells Fargo's sort of behavior as a bad actor in the lending industry is always something that's really concerned me. And what's very frustrating about their behavior to me is that they continually just get slaps on the wrist for what is highly discriminatory behavior. And so I think from a regulatory standpoint and a legal standpoint, I would very much like to see the stakes increase for lenders who are found to be bad actors and abuse their power as financiers in our system, rather than getting small fines and continuing to be able to really be major players in our industry, and to offer real reparations to the point that's being made here, to the millions of dollars that have been lost to homeowners during that process. I personally know of of friends who have tried unwittingly gone to Wells Fargo thinking they would be able to get loans and have lost out on deals because of how slow the process has been. And so I think a different approach to these types of lenders is really in order. And as somebody who's really data focused, what I would love to see as part of those reparations is access to their data. That we have to really, in a modern world, think about what are the tools of power that these entities have and get access to those, because that's really where today, that's where the bodies are buried. And so, those are the things that I would really like to see. And again, since I'm making call outs here, if the NAACP is on this call, I really think an action on their part would be tremendous for requiring bad actors to release their data to facilitate real, meaningful research on that type of work and the tools that are used to be exclusionary.
I wanted just to say that in St. Louis, especially north of Delmar, many of the banks don't provide mortgages under $75,000. I mean, it's not a matter of appraisal; they just don't have anything. There were like 4 families who were approved for mortgages north of Delmar, in a year. That's crazy. And what's happening is that these neighborhoods are turning into rentals with single family rentals everywhere. And it's the appraisals that do happen in these neighborhoods that are undervalued, and people can't sell, and they can't, get people to pay the difference. Then you get lower and lower values, gets to the point of under 75, and then you don't have homeowners anymore. That's the big problem.
Yeah, and I think to just close out the loop here, I think a lot of the conversations over the last several years have been in the name of certain advancements socially, and when you look at the data and kind of what the actual results are, the data and the metrics don't speak to the messaging of the legislators or the institutions. And so I think just having more honesty in these conversations about what's really going on and what are the intentions of the different stakeholders in the decision-making processes as related to some of these alternative valuation products as well would be advantageous in terms of thinking through kind of, what are our options as a society moving forward.
I think that's a poignant message for us right now as we're in a moment of potential change. Also, how do we help that change really result in? How do we help these actions that are being taken today really result in changes that are going to meaningfully and materially affect things like the racial wealth divide and the appraisal gap? Just before, I know there's a lot we can talk about here, but just to be responsive also to the chat on the role that this also plays. We're talking about appraisals, but this also. There are also related sets of questions to assessments. And I know, John, this is part of your broader work. Are there any pieces you want to share here?
Yeah, I mean, I think that the assessment process is extremely messed up. And it's something that is not really talked about because appraisal is kind of the moment, having its moment in terms of what needs to get fixed. But when you look at how assessments are provided in the United States, it's awful. And it has had a severe impact on the wealth gap and opportunities for different people in different neighborhoods. And so we need to take a hard look at that. And it's obviously hard in this country right now to get different types of governments and local government and state government and federal government all aligned on something, but especially with COVID and property, the acceleration of property values across America and the tax bills that hardworking Americans are going to be given in facing inflation and other rising costs, it's going to be a huge, huge problem, and we need to focus on it.
Yeah,
I'll just add to that because I think that same question mentioned the confluence of redlining with these locational adjustments, and that's 100% correct. In my own work with looking at race in an AVM context, we've found that redlining and the current racial makeup of the two cities that I'm working in right now, Philadelphia and New Orleans, are essentially the same. And to this other person's point, Christopher, about what's happening in Jacksonville, Florida, I think this is a great point that redlining created neighborhoods in the city core that were considered undesirable at one time, but have now become desirable over a century of those cities growing, and is allowing financial arbitrage to occur because they've been held at a lower value, though a premium location, for so long. And now you do see investors moving in and buying that property, or even just gentrification, higher income people who realize they can have the same locational benefit for a lower cost in these neighborhoods. So I agree with you, and that's why addressing the issue of redlining head on from a multidisciplinary standpoint, where municipalities are involved and investors or financiers are involved, I think is really critical.
And I know we're almost at time, and we can try and be good conversation citizens here. But so maybe if I could try, I have a lot more I'd love to hear each of you share about. But in some ways, Christopher's comment also brings us back to the starting point, right? For our own sake, we have been working on the evaluation of homes in Black majority neighborhoods. Appraisals are very important, but as Christopher points out, it is just one piece of a much larger, much more sophisticated, nuanced, and interrelated set of issues. And the role that investors are currently playing, the role that investors are playing in taking ownership in neighborhoods that have been disinvested from large financial institutions for long periods of time, as Rosalind was mentioning, homeowners who are transitioning to becoming renters, and the obstacles to home ownership and wealth building through home ownership are poignant. So I think even as there's an opportunity to make progress on appraisals, we also recognize that there's a need to address so many of the related and kind of adjacent topics as well. I want to thank you for this conversation. I know we could talk about so much more about appraisals. And if I could just reflect, I think as this topic is coming on people's radars, the broad conversation about it is still kind of in its very early days. But I think as the conversation between the three of you shows, there's already a more sophisticated conversation about appraisals and how we can address the structural problems that's developing. And that is, it's, while a lot of attention is focused on the fact that the market for appraisers, the labor market for appraisers needs to be fixed, and we need diversification in the market for appraisers. We also need a kind of a robust conversation that really looks at the kinds of structural changes that each of you are focusing on and pushing forward. And I hope this is an informative conversation for others who have joined us today. I certainly appreciated it, and I really look forward to seeing how this goes on and matures and brings about the kind of change that John was referencing. So thank you all for joining us today.